Good evening and welcome to today's market briefing. Our focus tonight is on developments in the silver market, where a notable divergence has emerged between pricing in China and Western markets. This difference, often referred to as a price gap, has drawn the attention of traders, analysts, and investors alike. Understanding this gap is critical for anyone engaged in global precious metals trading, as it highlights shifts in supply, demand, and market behavior across key regions. To begin, the term price divergence refers to a situation in which the same commodity is trading at different levels in separate markets. In the case of silver, the prices observed in China have not aligned with those in Western exchanges. This disconnect has been gradually widening, prompting questions about underlying market dynamics and liquidity conditions. While silver continues to trade actively in both regions, the relative value differs, creating opportunities and challenges for participants in the market. Several factors contribute to this divergence. In China, physical silver is typically traded through regulated vaults and exchanges that track inventory closely. Reported withdrawals from these vaults indicate the movement of significant quantities of silver, which can affect domestic pricing. At the same time, Western markets operate under different supply structures, often relying on futures contracts, ETFs, and other forms of paper silver trading. The result is that, even when global demand remains steady, regional pricing can shift independently, leading to observable gaps between the two markets. This gap has implications beyond simple price comparisons. For traders who operate across borders, the divergence may influence hedging strategies, arbitrage opportunities, and inventory management. Buyers and sellers in one market must remain aware of conditions in the other, as movements in Chinese silver prices can affect global sentiment and the relative attractiveness of different purchasing avenues. Investors who monitor these trends closely gain a clearer picture of market depth, liquidity, and potential risk exposure. It is also important to note that this price divergence does not imply an inherent weakness or strength in the silver market overall. Rather, it reflects differences in regional demand, supply logistics, and the structure of trading mechanisms. For example, local regulations, transaction costs, and the availability of physical silver can all contribute to temporary or sustained disparities in pricing. Observers have noted that periods of divergence often coincide with heightened trading activity, significant withdrawals from vaults, or shifts in futures contract pricing, highlighting the interplay between physical and paper markets. Analysts have emphasized that such divergences require careful monitoring. A sustained gap can signal changes in liquidity conditions, particularly if the volume of available silver in one market declines relative to demand. This may result in sharper price movements in response to smaller trades, a characteristic that can influence both short-term trading decisions and longer-term strategic planning. By contrast, markets with ample liquidity tend to exhibit more stable pricing, even amid global fluctuations. Understanding where and why the gap exists helps participants navigate these conditions with greater confidence. Global pricing dynamics also play a role in this story. The international silver market is interconnected, with movements in one region capable of influencing sentiment elsewhere. However, immediate effects may be muted if local supply and demand factors dominate price setting in a particular area. In China, for instance, the flow of silver into or out of official vaults can have a direct impact on domestic spot prices. Meanwhile, Western markets may respond more to futures contract activity, ETF inflows, and investor positioning, resulting in a temporary disconnect between the two regions. As the silver market evolves, these differences between Chinese and Western pricing continue to attract attention. Traders and analysts track the gap closely to assess potential arbitrage opportunities, evaluate risk, and understand broader trends in physical versus paper silver. While the divergence itself does not indicate imminent market upheaval, it serves as a reminder of the complex and multifaceted nature of global commodities trading. By observing both regional markets, participants gain a comprehensive view of current conditions and are better equipped to make informed decisions. In summary, the emergence of a silver price divergence between China and Western markets represents a significant development for the global precious metals sector. It reflects regional differences in supply, trading mechanisms, and market liquidity. Observers are watching these trends closely, as they can provide insights into broader market dynamics, including potential risks, opportunities, and shifts in investor behavior. The gap underscores the importance of monitoring multiple markets simultaneously and maintaining an awareness of how localized factors can influence global pricing. In the next segment, we will examine the details behind this divergence more closely, exploring how specific market activities, such as vault withdrawals and futures pricing, contribute to the observed differences between China and the West. We will also break down the implications for traders, investors, and market observers, offering a clear understanding of the mechanics behind this price gap. As we continue, it is essential to examine the factors contributing to the silver price divergence between China and Western markets in greater detail. A primary component lies in the differences in market structure and trading mechanisms in each region. In China, the silver market is heavily influenced by physical holdings stored in official vaults. These vaults provide a transparent view of inventory levels, and reported withdrawals or additions can significantly influence domestic pricing. When substantial amounts of silver are removed from these vaults, it may signal heightened local demand or movement toward export channels, directly affecting the supply available to Chinese buyers. By contrast, Western silver markets rely on a combination of physical holdings and financial instruments, such as futures contracts and exchange-traded funds. In these markets, pricing is often influenced more by speculative activity, investor positioning, and broader financial conditions than by immediate physical inventory levels. This distinction is crucial, as it explains why silver can trade at different levels in China compared with Western exchanges, even when global fundamentals, such as industrial demand or mining output, remain consistent. Another factor affecting the divergence is the timing of market access and trading hours. Chinese markets operate under specific trading windows, and daily inventory reporting provides immediate feedback on supply and demand changes. In the West, markets operate continuously across multiple exchanges, often with overlapping trading hours. The asynchronous nature of these markets can create temporary price differences that persist until arbitrage or other balancing forces act to align pricing. Traders who monitor these timing discrepancies can identify opportunities or anticipate shifts in local pricing relative to global benchmarks. Regulatory differences also play a significant role in shaping this divergence. In China, strict oversight governs the movement of precious metals, and compliance with reporting standards ensures that inventory changes are formally recorded. This regulatory environment helps maintain transparency, but can also create delays in price adjustments if significant physical movements occur outside scheduled reporting periods. In Western markets, regulatory oversight emphasizes market integrity and investor protection, but does not always provide the same degree of transparency regarding physical holdings. This distinction contributes to the observed gap in pricing between the two regions. Physical demand for silver in China represents another critical driver of the divergence. Industrial, technological, and investment-related purchases influence domestic prices directly. For instance, manufacturing demand for electronics or solar panels can increase the need for silver, while investor demand may fluctuate with market sentiment. When domestic demand rises sharply, it can create upward pressure on prices, even if global markets are experiencing relative stability. This localized demand, coupled with limited available supply, reinforces the differences between Chinese and Western pricing, Meanwhile, Western markets experience their own supply-demand dynamics, which can diverge from Chinese trends. Investors in these markets often rely on paper-silver instruments, which allow for greater flexibility in trading, but may not always correspond directly to immediate physical availability. ETF flows, futures contract settlements, and speculative positioning can cause Western prices to fluctuate independently of physical demand in China. As a result, even when global silver fundamentals are broadly aligned, regional pricing differences can persist, highlighting the complexity of international precious metals trading. Logistical factors further influence the divergence between the two regions. Transporting physical silver across borders involves costs, regulatory compliance, and timing considerations. These factors can prevent immediate price alignment, particularly when large volumes are involved. For example, significant withdrawals from Chinese vaults may not instantly affect Western markets due to shipping, customs, and storage timelines. Conversely, large movements of paper silver in Western markets may have limited immediate impact on Chinese spot prices. This physical versus financial distinction underscores why price gaps can emerge and remain for extended periods. It is also worth noting the role of market sentiment and perception in maintaining the divergence. Traders and investors monitor regional news, inventory reports, and trading patterns to assess market conditions. Differences in information flow, reporting frequency, and market interpretation can create temporary discrepancies in perceived value, even if underlying fundamentals are similar. In effect, the divergence represents not only tangible factors, such as supply and demand, but also the collective assessment of market participants in different regions. In addition to these structural factors, the interaction between physical and paper markets plays a critical role in shaping pricing. In China, a large portion of trading is tied directly to physical silver holdings, and price adjustments tend to reflect immediate supply and demand. In Western markets, paper contracts allow for leveraged positions, speculative activity, and hedging strategies that can amplify price movements without corresponding changes in physical inventories. The differing weight of these two market types contributes directly to the divergence, as each reacts differently to market events, news, and shifts in liquidity. Overall, the combination of trading structure, timing, regulatory oversight, physical demand, logistical constraints, and market sentiment creates a complex environment in which silver pricing can diverge between China and Western markets. Each factor reinforces the others, resulting in a gap that is observable and measurable, yet fully explained by these tangible market mechanics. As we move forward, the next portion will examine specific recent examples of how this divergence has manifested in market activity. We will look at reported vault withdrawals, fluctuations in futures pricing, and other concrete instances that illustrate the ongoing gap between Chinese and Western silver prices, while assessing the implications for traders and investors operating in a global context. Continuing with the detailed examination, it is important to focus on recent market movements that illustrate the silver price divergence between China and Western exchanges. Over the past several weeks, Chinese vault reports have shown significant withdrawals, reflecting active movement of physical silver within the domestic market. These withdrawals reduce available inventory in official storage, and as a result, domestic spot prices have experienced upward pressure. This activity highlights the direct relationship between physical inventory changes and pricing in the Chinese market, which contrasts with Western exchanges where paper instruments dominate trading behavior. In Western markets, silver futures, contracts, and ETFs have exhibited price fluctuations that do not fully correspond to the Chinese spot price adjustments. These instruments allow investors to take positions on silver without holding the physical metal directly. While this structure provides flexibility, it can also amplify price changes independent of tangible supply and demand. Consequently, a noticeable gap has developed. Chinese silver prices often trade at a premium relative to Western prices when domestic demand rises or vault inventories decline, whereas Western prices may remain more influenced by investor sentiment, trading volume, and broader financial conditions. The divergence is further influenced by arbitrage activity, which can sometimes bridge the gap between regional prices, but does not always do so immediately. Traders who have access to both markets may attempt to profit from price differences by buying in one region and selling in another. However, logistical, regulatory, and cost constraints can limit the effectiveness of such strategies, especially for physical silver. The result is that significant price discrepancies can persist for extended periods, providing insight into how market mechanics differ regionally and how these differences are reflected in observable pricing. An additional factor to consider is the impact of government and regulatory policy on silver markets in both regions. In China, the regulatory framework emphasizes transparency in reporting and limits certain types of speculative trading in physical metals. This approach ensures that price changes are closely aligned with real movements of silver within official channels. By contrast, Western markets operate with regulatory oversight focused on market integrity, but do not impose the same direct connection between physical holdings and price movements. This distinction further explains why the divergence has emerged and why it can remain over time without immediate correction. The role of industrial and investment demand in each region also contributes to observed differences. In China, industrial demand for silver in manufacturing and technology sectors can drive substantial consumption of physical metal. Investment demand, including purchases for savings or portfolio diversification, adds another layer of pressure on spot prices. Western demand, while also present, is often mediated through financial instruments rather than immediate physical acquisition. This difference in demand channels reinforces the divergence and underscores the importance of understanding local market drivers when interpreting global silver pricing. Recent trading patterns provide concrete examples of these dynamics. Reports indicate that during periods of increased withdrawals from Chinese vaults, domestic spot prices have risen relative to Western futures prices. Conversely, during intervals when Western ETF inflows or speculative positioning dominate, Western prices have temporarily moved higher without corresponding adjustments in Chinese spot prices. This interplay between regional market influences illustrates the complex environment in which the divergence persists and highlights the need for market participants to monitor both markets closely. It is also instructive to consider the influence of transportation and logistics on the divergence. Physical movement of silver between China and other regions involves costs, compliance requirements, and time delays. These constraints limit the ability of traders to immediately align prices across regions through physical arbitrage. Consequently, even when market participants recognize the price difference, practical considerations can prevent instant convergence, allowing the gap to remain measurable and significant. Another aspect that affects the divergence is the interaction between short-term volatility and longer-term trends. Short-term fluctuations driven by market sentiment, news, or sudden shifts in supply may temporarily widen or narrow the gap. Longer-term trends, shaped by structural differences in supply, regulatory conditions, and physical versus paper market weightings, provide the underlying context that sustains the divergence over months or even years. Understanding both dimensions is essential for traders, analysts, and investors seeking a comprehensive view of silver pricing across global markets. In sum, the second half of the detailed breakdown emphasizes that the divergence between Chinese and Western silver prices is not random or speculative. It is a measurable and explainable phenomenon rooted in differences in market structure, inventory levels, regulatory frameworks, physical versus paper trading mechanisms, demand channels, logistical constraints, and trading behavior. Each of these factors interacts with the others, resulting in a persistent and observable price gap that market participants monitor closely. As we transition to the final segment, we will summarize the key points from this detailed analysis and highlight the implications for market observers, investors, and traders. The closing segment will provide a clear, professional overview of what this price divergence signifies in terms of global silver market behavior, reinforcing the factual and objective understanding of current conditions. As we conclude this briefing, it is important to consolidate the key points regarding the ongoing divergence between silver prices in China and Western markets. This divergence, which has become increasingly noticeable in recent weeks, stems from a combination of structural, logistical, and regulatory factors that differentiate regional trading environments. Understanding these factors provides a clear and objective picture of current market dynamics and the behavior of this precious metal across global exchanges. The primary driver of the divergence remains the contrast in market structure. In China, silver trading is heavily tied to physical inventories stored in official vaults. Movements of metal in or out of these vaults directly influence domestic spot prices. Reported withdrawals have been significant, highlighting active market participation and creating upward pressure on local prices. In Western markets, silver trades predominantly through financial instruments, such as futures contracts and exchange-traded funds. Pricing in these markets is influenced more by trading volume, investor positioning, and broader financial conditions than by immediate changes in physical supply. This difference in market mechanics accounts for much of the observed gap between Chinese and Western prices. Timing and trading hours also contribute to the divergence. Chinese markets operate with specific trading windows and structured reporting of vault activity, while Western exchanges function with overlapping trading sessions and continuous electronic access. This asynchrony allows regional prices to move independently, with temporary discrepancies persisting until market forces or arbitrage activity reduce the gap. Even then, physical, regulatory, and cost constraints can delay full alignment, reinforcing the persistence of the divergence. Regulatory frameworks further distinguish the two regions. Chinese oversight emphasizes transparency and the alignment of prices with physical inventory movements, whereas Western oversight focuses on market integrity without directly tying pricing to physical holdings. This regulatory contrast ensures that domestic Chinese pricing reflects tangible supply conditions more closely, while Western pricing can respond more rapidly to sentiment and speculative trading. Both approaches operate within their respective objectives, yet together they produce a measurable difference in silver valuations. Demand patterns in each region provide an additional explanatory layer. In China, industrial and technological consumption, combined with investment-driven purchases, directly affects physical inventory and domestic prices. Western demand often flows through paper instruments rather than immediate physical acquisition, resulting in price adjustments that may not correspond to tangible supply. This difference in demand channels further reinforces the observed gap, highlighting the importance of regional context when analyzing global silver trends. Logistical considerations play a role as well. Moving physical silver across borders involves shipping, customs compliance, and associated costs, which prevent instantaneous price alignment. Even when arbitrage opportunities are recognized, practical constraints limit immediate convergence, allowing regional price differences to remain observable over time. Finally, both short-term volatility and longer-term market trends shape the persistence of this divergence. Sudden changes in supply or demand, news events, and speculative activity can temporarily widen or narrow the gap. Longer-term structural characteristics, including market mechanics, regulatory oversight, and the balance between physical and paper trading, sustain the divergence over months or even years. Recognizing the interplay of these factors provides a comprehensive understanding of why regional silver prices can differ substantially without implying instability or a breakdown in global market function. In conclusion, the silver price divergence between China and Western markets represents a clear example of how regional factors, market structure, and trading mechanisms influence global commodity pricing. The gap is measurable, explainable, and grounded in objective market realities, including inventory movements, regulatory differences, physical versus paper trading, logistics, and local demand patterns. For traders, investors, and market observers, understanding these factors is essential for interpreting pricing signals, assessing risk, and making informed decisions within the global precious metals landscape. This brings our coverage to a close. By closely monitoring the activity in both Chinese and Western silver markets, participants can maintain an accurate view of current conditions and ensure their strategies reflect the realities of supply, demand, and trading behavior worldwide. With this knowledge, investors and analysts are better equipped to navigate the complexities of a market in which regional variations play a significant role, and where informed observation remains the key to understanding global price movements.